Welcome to the Rigatoni Capital podcast. I'm your host, Colin. It is the morning of March 25th. It is brisk and cold, like a March day on Wall Street. About probably going to go up to 50, low 50s today. That means that the market should do well because it's sunny out. It's not doom and gloomy. I see that the stock pre-market, we are up on stocks. That's pretty cool. And I just want to say how much, real quick, how much I enjoy coming on this show every morning and kind of going through my stock market news. This is so much fun, and I hope you guys enjoy it. I just love it. I wake up in the morning looking forward to doing this more than anything else. So I kind of wanted to go over just the fact that Google was trading at 290 last night before after the market closed. I just can't believe it. Now, Josh Brown last night on his podcast said, "Hey, it looks like it's in no man's land," and he's correct because once you break this little support, it does look like it has so much more room to go, right? I think there's some psychology around that whole number of $300 per share, which it shouldn't, but it does. In my opinion, I think it might. And, I think that there is a group of buyers like myself that are just so itching to get in here and just wish they would have seen these gains, because I missed out on Alphabet. I really wish I was in Google. It's very frustrating, but I do believe that it isn't the time for me to buy, but I do like to see it pull back. I think it's a healthy pullback. I think Google trading now at a market cap of 3.5 trillion, and I'm sure their forward multiple has come down to a more healthy looking multiple. And these stocks are great long-term buy and holds, in my opinion. And some people would argue they're not, but I think they are. I think Google is going to be great, a great company in the next 5 to 10 years. Now, Microsoft is a different story for me. I think they have, it's silly to say this when Azure is growing so well, their cloud, but I don't know what the catalyst is. I think that's the problem. I think Microsoft looks very weak as I think the Microsoft 365, the old Excel spreadsheets, the old Outlook emails. I mean, that whole idea looks very outdated at this point with AI. Years later, it looks like it's run its course. But I think that Microsoft now, as you can see, has done full circle. It's come all the way back to April Liberation Day lows. I mean, we're getting to that area. And I drew this support line a long time ago. Not sure why. So I draw all these stupid support lines that I'm not a trader. I'm a long-term investor. But I still look at, when to entry, and I do like to look at support lines. Of course I do. Why wouldn't I? So I just think that Microsoft, I sold it and I bought it back in 2016, let's say, and I sold Microsoft last year at like a 450% gain. I was frustrated with Microsoft's exposure to OpenAI. I thought they were relying too much on OpenAI as a partner, and as an investment, and I didn't like that software as a service. I mean, that is Microsoft's business. So I was a little concerned. And, I guess I kind of sniffed out the whole Jordi Visser AI disruption story before it occurred on the beginning of this year. And then the Citadel thing came out, and the rest is history, right? The Citadel thought experiment came out. So I think that Microsoft definitely has more room to go. I don't feel comfortable cherry picking the bottom here. I would like to see a lot more panic. And as you can see, you can't see it because my face is in the way. Microsoft's up, as you can see, 1% pre-market. So there'll be these times where you feel like you missed it. Okay, let's go to something. So that's the market. And then look, I don't think it's smart for me to come on here every morning because by the time this comes out, all the news has changed. I record this pre-market Monday through Friday, and then it may become you probably don't see it on Spotify till 10:30 at least. 10:30 a.m. at least. So you can't for me to go through the VIX is trading at 25, the 10 years trading at 4.33. WTI is now at 88. Do you guys really want me to do that? I don't think that's necessary unless it's like I think WTI opening up the podcast with WTI is important since the US Iran war because the stock market's only trading on US crude. That's the only thing the algos care about. That's the only thing the stock market cares about is what WTI is looking like and what it's trading. This is a good leeway into what I wanted to talk about a little bit today was, I'm in this industrial food commodities ag space. That's what I do for my full-time job where pretty much it's specialty commodities. So ag food ingredients that aren't publicly traded on a ticker. That's called specialty. It's not on a ticker like soybeans. It's not on a stock exchange ticker. So those type of commodities, I'll use almonds as an example. That's what those are the commodities that I sell. And I'm not a farmer in California, but I work with growers, processors, and I work with the end user, which is maybe a distributor or it's Kraft Heinz or something like that. So sometimes it does seem like I got a good insight on macro before some other people do because I did know, I'll notice when we see all of a sudden customers that were about to contract suddenly disappear. We'll do a big bid on an item and then all of a sudden we don't hear back. And things have been really slow. I don't see people pushing out their contracts yet. That usually is a common thing in my business where I have contracts, let's say through June, and then I have customers that say, hey, I'm not going to be able to take all of this. It's just too slow. Demand is just too slow. I need to push this out through August. I'm not seeing that yet. I'm sure it's coming. What I am seeing is just people just quiet. It's just quiet. Nobody wants to look at a freight rate right now. People are concerned. Even if you ship it via rail instead of a truck, containers are stuck. Demand for, let's say, discretionary type of snack items is really down, and it has been down in the US for quite some time. What I'm seeing is something I would call a recession. And it's not that it's going to show up in GDP like 2 quarters in a row, negative GDP. I'm not saying that that's what I'm seeing. I'm not saying that's what this is going to result in. But once US struck Iran, I definitely have seen the entire macro space not look healthy, look very quiet. And it's certain that we could be seeing little glimpse of a recession right now. I think people that I talk to would agree with me in I'm not an economist. I never want to be an economist. I don't, it's not a job I would ever want. And maybe they would disagree, but I feel like I'm not going to be looked at as crazy when people see a very weak GDP coming out. What's going to look bad is manufacturing production. An ISM, for example, I guess is what I'm trying to say is like those type of data points in America. I feel like that's not true because defense manufacturers are probably rocking and rolling right now, right? And we know the data centers are still going to be built. So maybe that's not good. I'm just telling you, definitely there is a consumer that has pulled back. There's definitely a part of the industrial manufacturing space that has pulled back. And obviously, real estate doesn't look good either. So maybe we'll see a little bit of a weaker GDP 1 quarter, and maybe by then some of the US Iran war stuff has gotten straightened out. But when WTI hits over 90, I think that we're in recession territory. I think that my customers that were not accounting for the amount of freight costs that it takes from West Coast to East Coast America, once they see the pricing, that really affects margins, that affects mentality. It's a psychological issue as well. not just a financial issue. I didn't expect to talk about that, actually. That was not what I wanted to talk about today. But I was thinking about that. And I think about these things when I'm in the shower. Who would have thought? I was like, you know what? I think we're in a recession. Yeah, we're in a recession. All right. I talked about this stock all the time, and I own a very small smidgen, one of my smallest little holdings. It's called Brown and Brown Inc. I try to explain to you in a shitty way on what they do as an insurance company, how their structure is different on how they make money. You know, they are more so making money on like a fee service, and as you can see, nobody likes fees. Nobody likes ARR. Nobody likes that right now. Somehow it got stuck in this AI disruption thing. Like when you look at it, it has been selling off since this time last year, and I thought maybe part of it was AI disruption. You know, I know that sounds weird. Like, why would an insurance company get disrupted by AI? I don't know. It just seemed like it was getting wrapped up in that, but this has been selling off since March 2025, guys. So, you know, and this is a $22 billion market cap company. The ticker's BRO. BRO. Nobody knows about it. Nobody cares about it. I'm not going to get more viewers because I talked about Brown and Brown Insurance today. But this is a reason why I liked it. If you look before the sell-off last year, look at what the stock chart looked like. I mean, it was always bottom left, upper right. The family, the Browns, you know, the CEO today's third generation, they always executed and did well. I don't even know how I discovered this company, this stock. I could never tell you. Back in the day, like 10 years ago, I would use FinViz. I would screen the shit out of old boring stocks like this, and I would find them, put them on my watch list. I've been in and out of this stock for years, even though I'm a long-term buy and hold investor, but I finally decided to buy this stock on the pullback, and I just messed up. I obviously bought the stock, you know, and didn't realize it was going to be down. It was going to crater like this. I tried to figure out why Brown and Brown's selling off, and nobody really knows online. You know, sometimes I got to drink a sip of coffee, please. I'm so tired. Got no sleep last night. You know, you try to figure out why Brown and Brown is selling off, and you get these when you type into Gemini, you'll get these AI formulated type of, what would you call them? It's like AI wrote it and it's not giving you the answer. They're really bad. They're really useless and very frustrating. You know, you can go on FinViz. If you can see FinViz right here, I know I'm in the way, but you can see that. I feel like Tom Green in that movie. If you just look at the charts here when he's on the date, total revenues look fine. Operating margin, yeah, sure, it came down a little bit, but consolidated net income looks fine. That's in purple here. Total share, free cash flow looks fine. The only thing that I was interested in, because Brown and Brown, in my mind, was always a big stock buyback company. That's what I thought. Here they're doing stock buybacks, but they're also diluting shares. I guess that's pretty common. Total in this type of sector, let's say. So total shares outstanding, the CAGR is actually 1.2%. That was interesting to me. So I was like, is that something that I should be worried about? That's in the color green here. I know people are listening to this, and I rather listen to rather than watch sometimes. So I get it. But that's really the only thing I was kind of looking at that I thought was interesting. You know, I saw like a big increase in shares issued from the year 2024 into the year 2025. And for something like an insurance company like this, you don't like to see that. So why were they issuing shares? Very interesting. I did my research. I asked Gemini, is Brown and Brown Insurance diluting shares or buying back less shares? And they said they're actually doing both. Who would have thought? A company's buying back shares and they're diluting shares. Why would they be issuing more shares? Brown and Brown issued more shares primarily to fund its $9.83 billion acquisition of a company called Accession Risk Management. the parent company of Risk Strategies and 180 Intermediaries, which closed in the third quarter of 2025. The company used a mix of equity and debt for this blockbuster deal for several strategic reasons. And then it says massive capital requirement. Remember, this is a $20 billion market cap company that to cover the $9.83 billion price tag. So let's say at the time they bought this company, maybe they were trading at like a 29 billion market cap, and then now they're to cover the 9.83 billion price tag. The company needed multiple funding sources. So I guess we could have looked at enterprise value in this situation. You know, I would expect the enterprise value to be a lot less than their market cap today. Should we even do that right now, or is that a waste? Are you guys bored yet? We're talking about Brown and Brown, the most exciting insurance company stock that you'll ever find is on the Rigatoni Capital podcast. I mean, if I were you, yeah, here we go. Market cap's 22.75 billion today, and the enterprise value is 28.8 billion. So they obviously, this is why the stock's selling off, because interest rates haven't come down. And it'll explain to you, excuse me, primary debt, senior unsecured notes. So 400, it shows you the largest portion of their debt consists of 42 billion in senior unsecured notes issued in June 2025. These notes are split into 6 parts with varying interest rates and maturities. As you can see, but you know, the rates on some of these, I don't know how this works. We can have someone smart come on and explain it to us. It's not like you can, if you're locked in and rates go down, can't you renegotiate just like a mortgage? Like, can't you get a lower rate? But I have no idea. I'm not a banker. We should have a financial analyst come on and explain us the nitty gritty here. But like 1 billion at 5.5% due 2035, 1 billion at 6.25% interest rate due 2055. Long-term debt reported at 6.89 billion as of December 31st, 2025. So my point here is like, look, I would have never known this. I would have never known this if we didn't have AI. Now, at the same point, AI produces shitty content. For example, like I said, you'll type this in somewhere. Oh no, you know where I found it? It was right here. It was right here on TradingView. They do their little news updates, and it says 7 days ago, Brown and Brown price target announced at $76 share by RBC Capital. So they had a bunch of downgrades. You click on this article. Oh, it's going to Dow Jones Newswires. These are the articles I think are just generate. Here's one. I feel bad talking shit on this company. It's called Stock Story. Do you guys know who these guys are? I think they even might be owned by like Robinhood or TradingView. It's an AI generated thing. It just says Q4 earnings highs and lows, Baldwin Insurance Group versus the rest of the insurance broker stocks. This isn't the one I was looking for. Please disregard. Let's move on. What I'm trying to say is this website, Stock Story, you click on it and it tells you that Brown and Brown was downgraded. It actually isn't telling you why it was downgraded. It's just saying a bunch of companies downgraded it because it sucks. And that's the breaking news story. AI literally scanned the websites and generated a non-human answer. And they post it as if it's an article, and Google picks it up, and it's just not good. So AI is very helpful if you know how to use it, and it's obviously trash. It produces stupid content like this, and that's a shame. Anyway, let's move on to something near and dear to my heart, which is Palantir, my favorite stock in the world. Anduril, Palantir are developing Golden Dome missile shield software. The firms are part of a consortium working on the 185 billion project's operating system. I don't know why I'm bringing this up other than Anduril Industries and Palantir Technologies are developing software for President Trump's Golden Dome anti-missile shield. Isn't Palantir becoming more of a, isn't this more of a moat for Palantir? I mean, this isn't in their numbers. This isn't in their forward guidance, is it? It's the software. If the software works during its live demo, it could become the cornerstone of the $185 billion defense system, this Golden Dome, giving its makers a potentially lucrative opportunity to make billions of dollars developing and maintaining the system over time. After the Golden Dome software development launched last year, this guy added traditional defense contractors Lockheed Martin, Northrop Grumman, and RTX to help to develop the operating system. So just more money being poured into defense. And this is literally playing defense. A Golden Dome for America. A Golden Dome for America. The firms are part of working on a $185 billion project's operating system. I found this pretty cool or interesting. So who's going to pay for that though? Exactly. All right. Thesis rationale. Do not sell over war or panic. Thesis rationale is on Substack, and they posted a article last night, which I would recommend looking at. Invest with Thesis on Substack. The title is Do Not Sell Over War or Panic. Markets react to headlines. Compounding ignores them. Completely agree. I think we learned our lesson that you don't panic sell ever, but you especially don't panic sell over war. That's pretty obvious. I mean, war, if anything, unfortunately, can be an incentive to own assets like industrials, defense manufacturers. We know the story of World War II and how, that stirred growth. We know the history. So you never sell in terms of war, even though war can be bad. It can spike a commodity like oil that goes into everything. It can cause a recession, but that does not mean you sell your stocks. And remember, when I say I think we're in a recession today, the recession might only be a week. It might be 2 weeks, it might be 3 weeks. That's not the definition of a recession. It's 2 quarters, negative GDP, for example. And some would argue that's not even true now, right? Because that happened in 2022 and they said, no, it's not a recession because of import-export confusion. Also, and look, unemployment still at 4.4% and all that. So it's not like the end of the world, but definitely we see a slowdown, and slowdowns are as bad as recessions. And the stock market sometimes trades down and sometimes trades up. I think the most and sometimes the stock market is not the economy, is what I'm trying to say. I think in this situation, the stock market will sniff out a good 6 months forward. And I think that's what is going to happen in this situation. It can sniff out like, okay, this war is winding down, but we see oil actually will come back down. And we definitely, we'll be getting these data that we are in a recession. Like we'll be getting a negative GDP. Like, oh my God, we'll be getting bad news, bad data. But by then, of course, the stock market's trading 6 months in advance, so it doesn't matter. You understand that. That's easy. Investing 101. So anyway, recommend Invest with Thesis. I really like their stuff here on Substack. And then, of course, on Zero Hedge, we have upside tail risks are underpriced. Citadel Securities chief strategist offers April's capitulation checklist. Yeah, obviously, when everybody's bearish, there's always a risk for upside. I mean, isn't that kind of obvious? And it shows you like ETF net inflows January 1st through March 22nd. Look at that. ETFs, I mean, retail investors, institutional investors understand ETFs really well, I think, at this point. I think maybe they always did, but like now the regular Joe that has a Robinhood like understands the concept of owning a basket of stocks that are either market cap weighted or a sector ETF. Like they understand it, and maybe they're trading. Maybe that is what this is. But I really think that ETFs are just such a great way to invest. I always talk about that. I own individual stocks along with ETFs. I don't care if I'm over diversified. That's not the game I'm playing. I want to be over diversified, especially now. I'm like one of the only guys that I know of that, people my age own industrial type of old man, boring value type of stocks. People like me, I know people my age are probably buying Chubb insurance. They really are, because I'm old. But people that are like 5 years to 15 years younger than me, they don't even know what Chubb insurance is. They don't know what Brown and Brown is. Like it would be very rare that they own something like Caterpillar or Waste Management, right? Of course, they own it in other ways, in like their 401k through a S&P index fund. I'm just saying they're not looking at those stocks. So, and another way, this was like one of the reasons it was perfect timing for me to start this podcast, because it was kind of like low, which is Josh Brown's heavy assets, low obsolescence type of stock. Those were always stocks I had invested in, and people thought I was crazy. But it was always interesting to me that those type of stocks, like these, I call them like Bill Gates stocks, something that's like the anti-software, and Bill Gates owns all of them, So railroads, I mean, I love railroads. I love investing in railroads. I love investing in old, boring type of industrial stocks. I love, I don't love Lockheed Martin. I'm not for war, but I know that it's an important stock. That was the first stock I ever bought, was Lockheed Martin. So, and this was a long time ago. So I guess I was like, when this all happened, I was like, I got to start this morning podcast. This is the time for me to shine. Salesforce CEO Mark Benioff just shared a video of the Figure 03 robot handling packages on the production line. Another reminder that the AI story is moving beyond software and physical labor. I will play this video for you quickly, okay? I don't know if it'll play, because if there's no talking in the background, then it gets cut off for some reason.
Okay, Figure Robotics, pretty cool sorting algorithm. Its job is to turn these packages upside down. And I guess we can just take one. Let's see, we're going to take one of these packages. Oh, sorry about that. Oh, figured it out. Pretty cool. Wait, oh yeah, sorry about that again. And also this one. Its job is to flip them upside down. Yep, it's really impressive.
Okay, so impressive. And then Joe Trader on X is like, automation could do this task large multiples more efficiently on many fronts. Automation and robots are not the same. 100% agreed. I said, exactly. These 2 arms and 2 legs seem to lack imagination for industrial and gigafactory use cases. 100% agree with that. These seem to be a distraction to me. Yeah, they are cool, and yeah, I guess they could fold laundry in your house, but I think it's a distraction, don't you? I don't think this is what factory robots should look like. Why are we making them into 2 legs and 2 arms? Just seems like it's lacking imagination. Now, this is really interesting. And I don't know if this is true, because it's from X, and I never trust anything from freaking X. It is the worst social media site in terms of fake news, honestly, since Elon bought it. Amazon makes a big move in the humanoid game. Amazon has acquired Fauna Robotics, a New York-based humanoid robot startup. The reason this is so important, guys, is that it's lightweight. This is cool, I think.
One that's expressive, lightweight.
It's kind of like retro, too.
Durable, soft to the touch, designed without pinch points, and compliant. It's safe, capable, and ready to go. Sprout is a developer platform for people who want to build, not start from scratch, so you can focus on what excites you and trust the rest to just work. Perception, navigation, and movement right out of the box. Built by our team right here in New York City. A humanoid robot meant to be explored, extended, shared, so that one day robots can live alongside us, around the people who matter most. Sprout is just the beginning.
Sounds like they want you on their software platform, but definitely cool because it's lightweight. And I was on the Power is Power podcast last night. The theme of the podcast was to talk about robotics. Unfortunately, I couldn't answer the questions that were asked to me about Tesla, Boston Dynamics, Hyundai, and Figure. because I don't follow these stocks. But what I'm interested in my investing thesis is trying to pick the winner of who the next humanoid robots is not a good investing strategy, in my opinion. The only way I know how to invest in the future of physical robotics is semiconductors. It's really easy. I mean, God, you could just buy the SMH and just hold on to it for the next 10 years, and you're going to capture the humanoid investment thesis. Why are you trying to pick the next humanoid? Big mistake, in my opinion. And look, I hope someone like Tesla and Boston Dynamics, and I hope Figure, and I hope this Amazon, I own Amazon. I hope we get some cool robots. I really do. I think the problem is that you're making a mistake trying to invest in the end robot itself, and you really need to invest in the picks and shovels. And I talk about the robots will win in the end. And Josh Brown does the post, his famous blog post, which is chapter 1 of his book, which is you weren't supposed to see that. You weren't supposed to see that. Josh Brown explains in this context back in 2018 was like, hey, it's a good hedge to own Google, Amazon, Microsoft. Like, that's the hedge to make. Like, if you're afraid about losing your job from robots, like invest in the Mag 7 type of names. They weren't the Mag 7 back then, of course. But his idea was, to own these large mega cap tech stocks. That was kind of his context. And then we, fast forward to the year March 2025. So my idea is like, invest in the picks and the shovels in robots, and I talk about, in this post was from October 2024. If you recall, it was in the middle of the port strike, how we had such a scary time. And you think about this, was October 2024. Nobody knew I was writing on Rigatoni on Substack. I guess that was one of my first posts. And what my investing idea back then is the same thing I'm talking to you about now. The Lam Researches, the Texas Instruments, even heavy equipment stocks like Caterpillar and John Deere. If let's say you had discretionary income to invest in something and you're on strike at this ILA strike that happened, right? And remember, the strike wasn't just about salary and stuff like that, a salary bump. It was about protecting you from automation. You guys remember all of this? That's what these strikes are about. It's about to protect the employees from automation. That's really what the strike was about. But people wrapped it into salaries or whatever, bonuses and stuff like that. And if you want to look at, if you think this is all bullshit, just look at Chinese ports. And Chinese ports are all automated. This is a picture of a Chinese port. There's literally no humans anywhere around except for behind a computer, behind a software. So, and then you look at the US, well, because of lobbying and strikes, there's more employees. I'm just saying that could be the reason why, is that it's not a communist country. We had more of a pool, and we could say, hey, we can just shut down the ports. So what happened about this podcast last night? So Phil Pinelli, Clinton Smith, and we talked about robots, and I was trying to talk about the investing side of things. And unfortunately, I just didn't get to talk about what I wanted to talk about, and we just ran out of time. Now, this is a photo I want to talk about one day, and I might even write a post about it. This is the Morgan Stanley Global Robot TAM estimates. So what this post is saying is by the year 2050, that's how far it goes through. It starts through 2024, it goes all the way to 2050. It's saying that the global TAM revenue estimates, it doesn't say, the robot revenue estimates will hit 25 trillion by 2050. Someone like Jensen Huang would disagree with this chart. He would say, no, this is going to hit 50 trillion, guys. There's no way. That's what Jensen Huang would say. I bet you. Not putting words into his mouth. I'm just saying, I guarantee that's probably he probably think that's way undershooting this, too conservative. But let's just say it hits 25 trillion. Okay. But you can see that the amount of and I tried to do some math, like trying to figure out what is the TAM for semiconductors that need to go into the robots. And of course, my computer won't work, my desktop, but you could see that there definitely is an opportunity like the data center infrastructure build out we're having now for semis. So you see data infrastructure being built and all these chips need it. A similar investment capture can be had in the physical robots itself as well. So all these robots, home robotics, small drones, humanoids, industrial robots, which I think is way too small of a chart on this. Large VTOLs, large VTOLs are the vehicle, the large type of drones. That's how I would explain them, right? Like the large autonomous type of vehicles is what it's calling them. What else do we have here? I think that this chart just gives you an investment thesis for NVDA. It gives you an investment thesis for a Lam Research. And then you can even break down, I'll show you a photo here of Morgan Stanley's humanoid robots top 25. Of course, it goes over brain, eyes, body, and that's a pretty common thing that we keep seeing. I'm sure these photos will keep coming up that are made by like Notebook, but you can see Texas Instruments is always in here. I always see that. It's a very common theme. It's saying Texas Instruments is kind of like maybe like the nerves of the robot. You can think of it as like the nervous system, and then you can think of the brain as like NVIDIA, and CUDA, NVIDIA CUDA is going to be a very important aspect to this, and the twins software systems and all that stuff. Here's another post called Robotics as the key theme for 2026. And it shows you all the little sensors and the semi-analogs and, the Lam Research on how this is all important. All these fobs need to be inserted into a robot itself. You can just try your best to ask AI, what is Figure AI, for example. Figure is that robot we were talking about. How does Figure AI, what is Figure AI? What semis are going into Figure AI? We kind of have an idea of what Tesla's doing in terms of the semis going into Tesla, because isn't it going to be Tesla semiconductors? So that is my idea of a podcast today, guys. I can talk forever on the semiconductors going into physical robots. I'll do a little more research. I might just write a post about it and we can talk about it throughout the week if you're interested in stuff like that. Rigatoni Capital can be found on Substack, and we can be found on YouTube and Spotify. By the way, tomorrow morning I'll do my regular podcast, and then Friday morning I'll release a interview I have with Satishan, who is the Substack writer newsletter of Alpha Monk. And this is like very deep dive investment stuff, but it hits on exactly what we talk about here at Rigatoni Capital. I mean, everything that he's writing, most of the research he's doing, the analysis he's doing, is all the type of stuff that I'm interested in and that Rigatoni Capital is all about. So I found him on Substack and I reached out to him and I said, hey, would you come on this podcast? And then I interviewed him once before. It was really good. It's actually on YouTube. You can find it on YouTube. I don't think it's on Spotify because I just started doing the Spotify one, but it will be on Spotify and that will come out Friday, and it'll be more of a long form, like an hour-long interview. And he's going to talk about some of the research he's doing and what he wants to talk about because he's the guest. He's going to give us all of his expertise on his investing ideas. So looking forward to that. Thank you guys. Please subscribe if you don't mind on YouTube so I know you're actually watching. Thank you so much. Take care.